Welcome back to this Iron Financial Explainer. We are your hosts, and look, our mission here is simple. We want to help you forge a stronger portfolio and cut straight through the market weakness. If you're serious about building a rock-solid financial foundation, you're going to want to hit that subscribe button right now. Today, we are putting on our hard hats and conducting a full, rigorous structural inspection of U-Haul Holding Company, ticker symbol UHL. We've been digging deep into their fiscal 2026 financial results, and honestly, we're seeing a perplexing, massive divergence between their top-line revenue and their bottom-line profits. Now, in a high-rate inflationary environment like the one we're navigating right now, a divergence this wide is a glaring red flag for any investor. See, companies can often inflate their top line with aggressive price hikes, right? But if that bottom line is actively bleeding out, it tells us that operational costs are spiraling out of control, and that can mask some severe structural rot. This is a company doing an incredible amount of heavy lifting in the moving and storage sector, literally and figuratively. But we need to aggressively drill down to figure out if the underlying framework is actually holding up or if it's starting to buckle under its own weight. So let's get right into the numbers. We have to start our inspection with the revenue. And I'll be honest, at first glance, the top line looks like an absolute fortress. U-Haul posted a massive, record-breaking consolidated revenue of $6.04 billion for fiscal 2026. That's a really impressive jump from the $5.83 billion they posted the year prior. And this growth wasn't just in one corner of the business. It was broad-based across their key lines. Their self-moving equipment rental revenues rose to over $3.8 billion, and self-storage revenues hit over $972 million. Now, why does this matter? Because this isn't just about moving more volume. It demonstrates serious, tangible pricing power. They are successfully pushing through price increases to the everyday consumer across both the truck rentals and the storage units, and the consumers are still paying. When you're generating over $6 billion, you are pouring a very solid, load-bearing structural foundation. The consumer demand is clearly there, the macro headwinds haven't brought mobility to a dead stop, and the top-line cash flow is just pouring in like wet concrete. Okay, hold up a second. Let me jump in here. If the top line is such an impenetrable fortress, I need to know why the bottom line completely collapsed. Net earnings available to shareholders for fiscal 2026 came in at just $83.1 million. That is a staggering, catastrophic drop from the $367.1 million they posted just a year earlier. Think about that for a second. You're talking about a top line that grew by hundreds of millions of dollars, while the actual real-world profits evaporated by nearly 77%. You absolutely cannot call that a solid foundation. If I'm an investor looking at a 77% profit plunge during a record revenue year, I'm aggressively asking one simple question: where did the structural integrity fail? Where is all that $6 billion leaking out before it ever reaches the shareholders' pockets?
Section 1. Cracks in the foundation.
Those are exactly the right questions to ask, because a shiny exterior means absolutely nothing if the main support beams are rotting out from underneath. To understand this, we have to look back. Over the last 10 years, U-Haul has engaged in a massive, relentless campaign of capital expenditure. They have been doing the heavy lifting, reinvesting almost all their cash from operations into two gigantic operational silos: fleet growth and real estate expansion. They've spent billions, literally billions, acquiring land, fighting through local zoning laws, building self-storage units from the ground up, and constantly rotating a fleet of hundreds of thousands of trucks. Historically, they've funded this heavy expansion internally, alongside some debt and lease financing. But here's the catch. Managing two massive, capital-intensive expansion projects simultaneously for a solid decade requires relentless cash flow. The sheer operational undertaking and the physical scale of their footprint have just grown so large that the maintenance and depreciation of all these combined assets are now severely testing the limits of U-Haul's financial framework.
Right, and let's talk about the specific weight of that expansion, specifically the debt load they've strapped themselves with. On a trailing 12-month basis, U-Haul has an adjusted EBITDA of $1.65 billion. Okay, that's a solid earnings engine, no doubt. But then you look at the balance sheet and see total debt sitting at a massive $8.12 billion. That leaves us with a net debt to adjusted EBITDA ratio of roughly 4.3x. Now, let's put that into perspective. Back in the 2010s, during the era of zero interest rate policy, a 4.3x leverage ratio was just cheap fuel for building your empire. But today, the cost of capital has fundamentally repriced. In today's restrictive, high-interest rate environment, rolling over $8 billion in debt isn't cheap fuel. It's a potential structural trap. In fact, net cash provided by financing activities actually increased by $828 million in fiscal 2025, mostly from taking on new borrowings.
When your profits are actively compressing by 77%, carrying a 4.3x leverage ratio suddenly feels like a very heavy steel ceiling that is threatening to cave in right on top of your operating margins.
Section 2. The depreciation weight.
That's a totally fair concern from the skeptic side, but honestly, the debt load actually isn't the heaviest weight dragging down their bottom line right now. The real structural flaw currently ripping through the income statement is an unprecedented wave of fleet depreciation. To really grasp this anvil dropping on their margins, you have to understand a concept called declining balance depreciation. See, U-Haul doesn't use straight-line depreciation for these assets. It's heavily front-loaded. Their box trucks, for example, are depreciated at 16% of their cost in year 1, 13% in year 2, and so on. So why is that absolutely crucial today? Because U-Haul recently expanded their box truck fleet by nearly 11,000 units compared to December 2024. During COVID, they ran their existing fleet into the ground just to keep up with runaway consumer demand. As those older trucks naturally aged out, maintenance costs started blowing up, which forced them into a massive, immediate fleet refresh. But here's the problem. When you add that much brand new steel to the fleet all at once, that declining balance method accelerates the depreciation charges right at the very start. It violently front-loads the accounting pain, severely depressing current earnings to build for tomorrow.
But listen, those brand new box trucks are really only half the depreciation story. The other half involves the shorter-lived assets that have to turn over much faster. We're talking about the cargo vans and the pickup trucks. Back in the third quarter of fiscal 2025, U-Haul actually realized a net gain of $3.8 million on the disposal of retired rental equipment. But fast forward to the exact same quarter in fiscal 2026, and that metric completely flipped to a net loss of $26.2 million. That is a brutal, unmitigated $30 million negative swing in a single quarter, entirely from dumping retired vans and pickups into the open market.
Let me break down exactly why that violent swing happened, because honestly, it is a classic macro environment trap. Think back to the post-COVID supply chain nightmare. Original equipment manufacturers, your GMs, your Fords, they had severe vehicle shortages. At the exact same time, these OEMs started pivoting their limited production capacity heavily toward electric vehicles, significantly cutting the production of the internal combustion engines that U-Haul heavily relies on. Ford literally eliminated shifts at the specific plants producing these commercial vans, so U-Haul was backed into a corner. To keep their rental fleet operational and meet demand, they had to buy whatever limited supply was available on the lot. That meant they were massively overpaying for 2023 and 2024 cargo vans at peak pandemic pricing. Fast forward to today, and the commercial used vehicle market is completely crashing. Other fleet operators are dumping inventory, high interest rates are severely choking off small business buyers, and U-Haul is now forced to sell off these hyperinflated vans into a weak, saturated resale market, absorbing heavy, unavoidable losses on every single disposal. They bought at the absolute top, and they're selling at the bottom.
Hit the nail on the head. And when you aggregate the accelerated front-loaded depreciation of those 11,000 new box trucks and you combine it with the heavy disposal losses on those severely overpriced post-COVID cargo vans, you arrive at the staggering figure. $186.6 million. That is the massive year-over-year rise in overall fleet depreciation for fiscal 2026 alone. As U-Haul's chairman Joe Schoen explicitly stated to his own investors, we continue to undermine earnings with fleet depreciation and poor resale results. This single massive metric acts as a solid iron anvil, dropping squarely on their operating margins, and frankly, it explains the vast majority of that 77% profit collapse we talked about earlier.
Lead Analyst, Section 3. Storage Unit Squeeze.
All right, we've thoroughly diagnosed the structural weakness on the moving and fleet side of the business. Now, let's shift our focus to the real estate side, because their North American development pipeline is truly staggering. Over the last 5 years alone, U-Haul has added over 27.9 million net rentable square feet. And right now, as we speak, they have roughly 11.7 million net rentable square feet currently pending or under construction. This is a massive, aggressive, overbuild strategy, planting heavy physical flags in almost every single major market. But you have to realize the operational drag here is immense. Managing hundreds of different properties that are all caught up in various stages of zoning, permitting, or just pouring concrete requires intense capital and management focus, all while yielding absolutely zero current return.
And here is the immediate structural flaw with that strategy. Just look at the capital commitment sitting in limbo right now. There is a massive $1.3 billion already sunk into these pending locations. That is $1.3 billion sitting heavy on the balance sheet, fully capitalized, that is not yet fully operational. Joe Schoen himself admitted they are pushing a, quote, bow wave of costs associated with built but not rented storage units. You've got construction delays, endless local zoning fights, heavily inflated raw material costs, and it has all severely exacerbated this $1.3 billion hole. It really begs the question, if you build it, will they actually come? Because right now, that money looks like a massive wave of unrecoverable costs just dragging down their overall return on invested capital. Are they building an impenetrable real estate empire, or are they just pouring highly expensive concrete into a bottomless pit?
It's a highly calculated risk for sure, but let's balance the data here. Yes, adding all that massive capacity has temporarily softened their current operating metrics. Same-store occupancy has slipped by 5.4%, bringing them down to 86.1% occupancy. That's just math. When you aggressively flood your own market with new supply, your occupancy percentages drop. However, and this is key, they are successfully extracting more revenue from the units they do actually rent out. Revenue per foot increased by an impressive 6.5%. You have to remember, self-storage is an incredibly sticky business. Once a customer loads their entire life into a unit, they very rarely endure the physical, exhausting hassle of moving it all again just to save $10 a month down the road. That sticky, stabilized revenue potential, once these newly built units eventually hit that golden 90% occupancy mark, could be the ultimate reinforced concrete that keeps this whole foundation solid over the next decade.
Section 4. Electric Vehicle Shockwaves.
Structural integrity isn't just about how you build your internal business. It's also about what external forces are hitting the outside of the building. For U-Haul, the biggest looming earthquake comes from external regulatory pressures regarding electric vehicles. In their annual report, U-Haul management outlines this explicitly, stating that government insistence on all electric vehicles may result in regulators knowingly or unknowingly choosing the winners and losers. The prime example here is the Advanced Clean Fleets, or ACF, regulation adopted by the California Air Resources Board, which aims to legally phase out internal combustion engines and replace them with zero-emission vehicles. Now, while California has temporarily withdrawn its waiver request to enforce this, the structural threat absolutely remains. To accommodate these potential regulations, the physical infrastructure upgrades required are mammoth. We're talking about installing heavy-duty, commercial-grade charging stations at thousands of independent neighborhood dealers, many of which simply do not have the electrical grid capacity to support that kind of massive megawatt draw. Yeah, let's talk about the brutal real-world logistics of this, because it's wild. U-Haul's core business model relies heavily on one-way interstate moves. You pick up a truck in California, you pack up your house, and you drop it off in Texas. Under an all-EV mandate, that entire model relies on a seamless, high-speed, in-transit recharging network across rural North America. As U-Haul points out, that network simply does not exist today. And even if it is eventually built, the increased vehicle rental cost and the sheer downtime required to sit and charge a heavy-duty moving truck could completely destroy the efficiency of their business model. Plus, they note growing evidence that their core do-it-yourself consumer might outright refuse to use an all-electric solution for a highly stressful long-haul move. U-Haul is basically warning investors right now that they're at risk of being squeezed in a vice between government mandates on one side and fierce consumer rejection on the other.
Facing these massive depreciation weights, sunk real estate costs, and severe regulatory unknowns, management isn't just standing still and taking the hits. They are executing a major defensive maneuver. To stabilize the foundation, management has officially announced plans to slash new truck purchases by over $500 million going into fiscal 2027. By heavily cutting CapEx on rental trucks, they are actively attempting to moderate that massive fleet depreciation we discussed earlier, giving the balance sheet some much-needed time to digest the assets they've already acquired. But there is a heavy risk to slashing CapEx like this. By halting purchases, they are essentially allowing their overall fleet to age. This just kicks the can down the road. Older trucks mean a massive spike in future maintenance costs and potential customer dissatisfaction if on-road breakdowns increase. It's a strategic pause in the heavy lifting to let the concrete cure, but it is a risky one for sure.
Section 5. The Iron Verdict. Let's bring it all home.
We've inspected the revenue, we've drilled deeply into the depreciation, the real estate overbuild, and those looming regulatory threats. It is time for our final assessment. On the bull side of the ledger, liquidity is incredibly strong. The moving and storage segment alone sits on $1.479 billion in cash and available credit. They've also authorized a brand new $350 million share repurchase plan. Now, when management buys back stock amidst a 77% profit plunge, they are flashing a massive signal to the open market that they believe the underlying assets are deeply undervalued and that the current accounting pain is strictly temporary.
On the bear side, though, you absolutely cannot ignore the severe margin compression. The heavy leverage of a 4.3x net debt ratio, combined with the used vehicle market that is severely depressing the resale value of their retiring fleet, pretty much guarantees that the next 12 to 18 months are going to be financially painful.
So, what's my final verdict? Look, U-Haul is a foundational American business with an impenetrable competitive moat. But right now, they are paying the iron price for post-COVID supply chain distortions. The underlying self-storage assets will generate sticky, reliable cash for decades, but investors really need a stomach to absorb severe near-term accounting losses while the fleet rotates and normalizes.
And my verdict? I see a company that got completely trapped into overpaying for assets during a panic and is now dealing with a $1.3 billion pile of unrented, unfinished storage units. The 10-year long game might be solid, I'll give you that, but right now, this looks like a severe structural trap. Until management can prove they can stop the bleeding on vehicle disposals and actually get paying customers into those new storage units, this heavy lifting phase is going to just eat all the profits.
Well, the data is all laid out before you. They have the massive top-line revenue, they have the cash reserves, but the immense weight of depreciation, leverage, and expansion is severely testing their structural limits. So we turn the question over to you. Based on this drill down, is U-Haul forging a stronger, dominant future in the self-moving and storage market, or are they slowly buckling under the weight of their own massive expansion? Sound off in the comments below, let us know your iron verdict, and we will see you in the next explainer. Keep building that foundation.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.